Hey guys, what's going on? My name's Drew Demon and I'm the Devil Stockbroker, and I'm doing a quick update here on the SPY and the stock market just to keep everybody up to speed on what's going on with the market, find out what directions that we're looking to make our next plays, and see where we're going for the week. So let's go ahead and get started. On the daily chart, we still see that the SPY is still tracking in this big expanding megaphone pattern to the downside. Right now, we're currently playing a big double bottom pattern, which we are looking for it to break down. Right now, the double bottom pattern is still in this range, pretty much between the wicks of this green candle here from the 17th of July. The lower low of the wick is essentially the last leg of support before the SPY has basically nothing but air underneath it. You can see this by using a volume range profile to determine exactly where there is volume, and unless you go all the way back, and I mean all the way back to 2021, you will see that there is nothing but air below in this range. So until we get back to about $340 on the SPY, that is essentially the next zone of support for the SPY, and then below that we have 320, and that would take us all the way back to the peak of the pre-COVID crash. Below that, there's still quite a lot of volume, but it's pretty much just this leg of volume here, as well as leading into the COVID recovery. So these two legs of buying, which was exclusively buying, is the last thing left once we get down to these levels. And this is a pretty huge area of support for the SPY. And honestly, like, for us to go down any lower than that, we would basically be looking at like complete capitulation of the market, and it would basically be blood in the streets, rest assured. So going back a little bit further, I want to take us back to the weekly chart and see what other trends we can find here, going all the way back to 2008. If we take a trend line from the bottom and then cut straight through the bottoms of our crashes from 2018, 2019, and 2020 COVID crash, and then just continue that trend, we see that we have pretty much a nice line that leads us to the very tip of this descending wedge that I've drawn here on the SPY. Okay, so zooming in a little bit closer, there's another pattern that I want to point out here. This is an extremely rare pattern and probably the largest that we've seen on the broader market. What you're looking at is essentially a giant inverse cup and handle. Now, a standard cup and handle is just upright with a large cup and then a smaller U, and then you basically play the line where there is horizontal resistance and then a breakout, and that's the direction that you play it to. Well, an inverse cup and handle is just the opposite, and now we have a breakout line directly below us right here. That's this double bottom. So this is a significant area of support, and once the SPY breaks through it, like that's it, man. We really are looking at major disaster standing in front of us. We are basically on the edge of a cliff. In my video that I released earlier today, Monday, September the 26th, it was meant to actually be released in the morning, so sorry that got out a little bit late, but I was estimating that today we would see a quick sell-off in the market and then a recovery, and you'll note that that's exactly what happened. We had a sell-off, quick recovery, and then resume sell-off. Now we've essentially double bottomed with equal parts, equal lows here. So there is potential for us to see a turnaround Tuesday, where we might actually retest these previous highs at 370. Notice we've got some significant areas of resistance that we broke below. We've tested it once, and it looks like the market was going to try and make a run for it, but got rejected by this new level of resistance. The other thing that I pointed out during my stream in Hell's Trading Floor on the Discord channel was that we also have a head and shoulders pattern here at the same time. It's a weekly drawn head and shoulders because it's coming at the bottom of a chart, you know, a downtrend. So some might interpret this as a diamond bottom. I don't really think that this fits that pattern. but I am taking note that we have multiple patterns that are conflicting with each other, so we have to turn to indicators and find out what is the most likely scenario going forward. All right. Now, I'm taking what I know. Right now, we are trading in a giant downtrend. Okay, we have a bear market. We know that much. We were trading this bear flag before, and we played that to the downside. Now, if we zoom out even further, go out to the hourly chart. I'll go out to the hourly chart here with a few less lines and disgusting mess all over my charts, and make things easier for everybody to see. Okay. So now the other thing for us to watch for is that we are trading in a channel. I'll actually use a regression trend in order to give ourselves some direction. We are trading at the bottom of a regression trend. Okay, let's bring that back a little bit. So technically speaking, we are at the bottom of a regression trend. This is essentially what I'm thinking. Okay, I'm thinking that the market is going to probably try to make a run for turnaround Tuesday, okay? And we will have to test this new high, all right? We'll have to retest this area. If we do manage to break that and fill this gap that formed here on the SPY, then we're going to retest this trend line above us at around 378, 380 or so. That's about as high as I think that the SPY is going to get. And this will be a very short-term rally, if at all. We still have seasonality working in our favor to the downside, meaning that the market has a lot of room to fall below. And like I said, I'm playing to this price level and a final take profit of this price level down at 320. These areas are significant because of that support that we've seen during the COVID recovery and before the COVID crash even happened. The other reasons for why I think that this will be a very short-term, very short-lived rally is because we do have the bullish cross in the MACD. However, we are consistently drawing lower lows on the MACD, and we are getting lower lows on the RSI and getting rejected repeatedly via these hidden bear patterns, these hidden bearish divergences on the RSI, where the price is making lower lows, RSI is making lower lows, and also getting rejected by its moving average. That's the green line in the center of the RSI. So all of these indicators point to the same thing, that we have more downside ahead of us. If we get any relief at all, I'm basically not going to play it. I'm pretty much all in for the short play, and I'm being really aggressive. This is something that I want people to be mindful of and careful of, is that if you're going to play SPY or the broader market to the downside, and you're playing very aggressively, you want to consider getting some hedges. I spoke about this on my previous video just today, that using leveraged ETFs like SPXU to short the SPY, or SPXL to go long in SPY, or UPRO, that's also another long ETF. Basically using those leveraged ETFs such as UPRO, SPXL, SPXU, and SPXS, they all have the advantage of being much cheaper and giving you access to leverage, which allow you to minimize your cost average when you're making a play. So if you do think that there will be a short-term rally in the SPY, notice this is looking very similar to SPY's charts. So if you want to play the SPY to the upside, but you're trying to play it for only a small amount of money, or you're just trying to hedge your bets with some calls on the SPY and you're long on puts for the month, then you can use UPRO instead, and that's much cheaper. And if you end up being right and there's some upside, and we do manage to fill this gap, this is the same gap as what's on the SPY, then you take profit on UPRO as soon as you touch this resistance, and then you go back into something like SPXU, and then as soon as SPXU does that same thing, like notice this gap, this is literally the inverse of the SPY. If SPXU comes back down and touches this area, you can go long in SPXU and play it to the upside. So some ideas that I wanted to toss around with people. Keep in mind, we still have all of these technical patterns that are playing in front of our very eyes, showing that we've got major downside risk for the market. We have the VIX, which has now officially broken through our descending trend line. If we go back to the daily chart, we closed above for the first time. Like this is it. This is it. This is a crash signal right here. We've been creating these lower lows, and for the first time on a daily candle, we have actually closed a candle above above this level, this descending resistance. And the MACD is going parabolic right now. Both of these extremely bearish signals. There's everything happening in this market is telling us that things are getting worse. Dixie is still going higher. We had a little bit of pullback today, but by and large, the dollar index is getting stronger. Gold is still in free fall right now, but I do expect that once the dollar starts to underperform, the elite wealth on Wall Street is going to start shifting over into gold and precious metals, and that's going to cause gold to start ripping and the dollar to start retreating, which may help our inflation problem, but it's probably not going to be as magnificent. Rather than using gold as a bet, I'm using it as an indicator to tell me what the market is thinking. Gold is still going down, as well as the high yield grade bonds. High yield corporate junk bonds. These are high risk bonds bundled up in an ETF. This is a basket of very high risk growth companies, and when you see that this is retreating, this tells you that this basically leads the SPY. So I'm literally giving you a hack to the market where you see HYG just selling off the way that it is. You can literally put SPY behind this, and SPY is doing the exact same thing. If you go back in time and you look at major events like Jackson Hole, you'll notice that HYG was going down while the SPY was, oh, well, this is May actually. Jackson Hole was, yes, it was right here. The SPY was ripping the whole time. That's this orange trend line. SPY was ripping, but HYG was consolidating, actually making these indecision doji candles, which was actually very risky and concerning for the market. You go back even further, and while the SPY was ripping towards the top of its charts in mid-August, y'all remember Apple was going crazy, Tesla was going crazy, everything was just going straight up. HYG was curling over. It was bending over in order to let everybody know that the market was not healthy. And in fact, it started going to the downside 3 full days ahead of the market before it made its huge drop, and the market gave back 10% in the next 2 weeks. HYG predicted that move. This is something that you can use in your own trading strategy to tell you what the SPY is going to do. If you see the HYG doing the opposite of what the SPY is doing, trust the HYG knows what it's talking about. These are bond traders. They know what's up. So if you see HYG going down while the SPY is ripping, then you know that the SPY is wrong, okay? We can also take a look at the broader bond market, which you can see over here. It's not as impressive, but the bond yields are currently going pretty high, which is bad for the market because it usually means that as these yields go up, these become more attractive, riskless assets because these are fixed income. These are fixed returns. So a 5-year bond with a 4.2% rate of return is 4% guaranteed yearly returns, and this is only going up. The yields on these are only going up. 10-year bonds, 2-year bonds, and the 5-year bonds. Especially the 10-year bonds tell us everything that we need to know about where markets are headed, and this lets us know that there's a lot of fear in the market, so everybody's moving over to the stock market. Equities market is going to start moving over towards putting money into bonds. This is a more attractive investment, and as well, because this is going up, this is telling us that short-term bond traders are selling off. They're selling off assets in order to move into longer-term bonds, like the 3-month T-bills, the 1, 2, and 3-month T-bills. These are all being liquidated because the yields are going up, especially in the 2, 5, and 10-year bonds. So all of these things point to major market strife and a crash ahead of us, and this one looks like a big one. XLRE, it gave up another 3% today. XLRE is looking disastrous. The whole housing and real estate market just absolutely tanking. Nothing is doing well today. And as a matter of fact, the home builders are now starting to really feel pain. Companies like D.R. Horton, which is now being sued by homeowners because they sold unfinished houses or mold homes. If you want to check out another YouTube channel that speaks frequently on housing and the situation with the housing market, strongly recommend checking out Real Estate Mindset. That's a channel that I pay close attention to when it comes to real estate. It's run by a former loan officer and real estate expert. He is a person who does actually know what he's talking about. He does loan origination. He's seen a lot of things in the real estate market, and he can tell you a lot of the same things that I am. Basically, that home builders are getting shafted right now, and companies like Lennar are looking like a very attractive short near the top of their charts. D.R. Horton, especially, which is America's largest home builder. D.R. Horton is actually getting reamed right now with recalls on the homes that they've built, and that's only going to get worse. So support for these guys is starting to look worse and worse. So I'll be looking to enter into short positions to play these guys to the downside between now and the and late 2023. This is a bit of a long short position for me, long-term short position. Sorry, English is a funny thing, isn't it? So anyway, I'll recap with some of the other primary stocks on the SPY just to wrap things up and give you guys an idea of where the broader market is headed. So let's start with Apple. Apple, I still think, is immensely overvalued. We're still basically at the top of Apple's chart. Like, make no mistake, the entire situation with Apple tells us that on average, like, this is actually just, I'm just going to draw a average trend line. We haven't even broken the average from where it's been in its downtrend since the market moved down. But like, if we even go all the way back to 2020, this is where the pre-pandemic highs were, and most of this ahead of us for Apple is like thin air right now. So Apple's trading way up here at $50, and I'm estimating that Apple needs to come back down to $100 before the end of 2023, before it goes back to a reasonable valuation. This is it's not like it's a bad company or anything, but the valuation makes no sense. The company is not earning enough cash to justify this valuation. The market cap on the company literally puts it over $1 trillion, and there's not $1 trillion worth of assets and cash in Apple's name. They're a valuable company, don't get me wrong, but they're not a $1 trillion company. That's absurd. So anyway, looking to Apple for it to finally give up the ghost. We're now getting into the phase of the crash. We're in late stage crash mode now, and Apple is finally starting to show a little bit more weakness. On the daily chart, we printed an inverted hammer candle. This is not quite a tombstone because it closed green, but we did gap down for this candle, and we intersected with the previous red candle from Friday. Now, the interesting thing is that this candle had a very large wick on it at the top, and we got rejected harshly. We didn't even retest this previous high from this wick on the 22nd of September. So this is now a lower high on this trend line. So what I'm anticipating is for Apple to kind of peter out and towards the upper end of this channel at best before it finally sells off. But if I'm being honest, I'm kind of anticipating Apple to just follow this channel down the middle until until Apple finally gives up and investors start to become more concerned about the financial situation of the company as they continue to lose money. MACD. My justifications for this are MACD has rejected again. It's floating below right now. So unless Apple does something strong to break out of this channel and get out of this bull channel, this downward channel that we're currently in, there's not really much opportunity for the MACD to cross back up and give algos a reason to jump into the company. Also still trading below its RSI moving average, and we no longer have bullish divergence on this latest candle. if anything, this is just kind of sideways chop and consolidation with a little bit of downside. So there's not a lot to look forward to in Apple, at least not until late 2023, when it reaches the bottom of its chart. As I said, I'm very bearish on Apple for the time being. I probably won't be looking to buy this company until it's trading down at a more reasonable level sometime at the end of next year, once we get on the other side of this crash, assuming that there is a Fed pivot. Until there is a Fed pivot, I will never trust that Apple is trading an accurate valuation. I feel very similarly about Amazon, although Amazon is a little bit closer to reality. There's still some room for them to go. They have already kind of tapped their pre-COVID high. So this was the high before the COVID crash. However, this kind of came out of nowhere on a very unusual and bullish earnings. So honestly, I'm treating this price level as a more realistic level to play Amazon to. So $95 is more my price target. Probably seeing Amazon undercutting this at some point before the end of the year, sooner rather than later, because we still have a holiday rally to get through. So if Amazon does in fact take a huge drop going into late October, then I'll be taking my profits down here around $95, $100, and then probably play it to the upside for the holiday rally for Q1 earnings season. And then maybe we'll see Amazon recover. I don't know. We'll just have to see how the economy shakes out. But for right now, I remain bearish on Amazon. Tesla, very much for the same reasons I'm short on Apple. I'm also short on Tesla, just because the company is overvalued. I mean, the price to earnings ratio is over 100. So for every dollar you invest, for every $100 you invest, Tesla is only earning $1, which that's an expensive stock. Like that's an insanely expensive stock. So the market has overvalued this, and right now it's trying hard to hold the market up, but fear is starting to take hold. As I mentioned, the VIX closed above that trend line, so 322.25 on the VIX is a scary number. And by the way, I'm long on the VIX as well, to let you know just how convinced I am that the market crash is coming very soon. This may not be the big drop, but I think that a big drop is coming. And at the very least, if we do not see a big drop, that we will see these price levels again before we get into November, and then perhaps as we go into the Christmas holiday season, we may see a little bit of holiday rally, but a weak rally will indicate a very bearish new year, with us going into a very negative trend, and we may yet see the greater crash, the long capitulation, where we see something like the stock market do one of these numbers going forward. Last thing that I'll touch on, just because it was asked so many times, BBIG, just to give an update. So the court settlement has been put through. I think that we're waiting on a few final signatures just for the Zash Global Media team to iron things out with BBIG and Vinco Ventures. But as it stands, it looks as though Ross Miller, the formerly court-appointed third-party CEO that was going to co-CEO along with Lisa King and John Colucci at the same time, which made no sense, it's been decided that he's going to be a permanent member of the team and stay on as the sole CEO of Vinco Ventures. And I think that this will basically mean that the merger for Vinco and Zash Global Media will go through, and then control will be handed over to the Zash Global Media team in conclusion, once everything is all ironed out with legal paperwork. This process is probably going to take some time, so it could be a while before we actually see appropriate pricing of BBIG according to a reasonable valuation for its assets and intellectual property. But for the time being, the chart was looking really good. We had a move to the upside really sharply in after hours, and then we formed this bull flag, and we are still in consolidation for it, just moving slightly to the downside. But we are at a point of support now. If the price gets accepted at these levels, and we see that BBIG is held up at around the 92-cent mark, then we may see a move to the upside sooner rather than later, where BBIG retests the outside of this descending wedge that I have pointed out here. So this area is critical for Vinco Ventures, the BBIG ticker. Once we start seeing the announcements and the PR coming from the Zash team showing that they will be going forward with the merger, which undoubtedly they will be, then we will probably start to see some upward price action and consolidation before we move on to each new leg of the journey. So this is probably one of the last few times that we'll see BBIG at these price levels, to be honest with you. It's been a long time waiting. We've had to deal with a lot of just absolute bullshit, but it's my hope that shareholders will be vindicated, and we'll see the company start to be priced more appropriately going forward. That's going to be it. I will cover additional tickers in a future video, but for right now, I think this will satisfy. I hope that everybody is doing quite well. If you are tracking the plays that I am calling out on the SPY, so far things have been working out exceptionally well. The market has been red for a long time. I'm sorry about the XOM bet. That really hasn't worked out yet. But if you're still in it and decided to just stick with the trade, either because it's gone too low, there's no point selling, or just because it's you still have faith in it, whatever the case may be. I'm actually still in my positions as it happens. I decided at the last minute not to get out, just because it didn't really make sense to me. It's already given up a lot of gains, so I'll wait and see if it holds up support at this price area for XOM. But anyway, I'll cover that in another video. The tech sector is basically all that I have been shorting for the most part, along with some financials. And Bank of America and JP Morgan Chase both gave up a significant portion of their value today. So if you were short on any of those, JP Morgan, Bank of America, Google, Meta, Apple, Amazon, Tesla, then you should have done very well. And I'm still continuing to stay short on all of those companies going forward. Right now, we're just kind of waiting for the bottom to fall out beneath the market. So keep up the good work, keep paying attention to the technicals, and good luck to everybody going forward to the rest of the trading week. For now, I will wish you good luck and have a hell of a time in the markets.